please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
As you have pointed out, the big story this morning is the global sell-off. Where do things head from here on, both for Indian markets and for global markets? Richard Harris, Chief Executive, Port Shelter Investment Management, and Albert Lung, of AEJ Rates strategist at Nomura, join on the phone line. Sorry. Good morning, gentlemen, and thank you very much for making this unscheduled stop. This was an unscheduled fall as far as we are concerned. Richard, first to come to you. This fall is still because there has been very good growth data. So do you think that both in EMs and in the US, the fall will be bought?
Sorry, could you repeat the question again?
No, I mean, the fall in equities is largely because growth was very good, and that's why you saw the spike in yields. Therefore, is there a chance that investors will return very soon to buy the dip in equities, both in the US and in EMs?
Well, I think, that's likely to be the case because we're not in bubble territory, although we have had a very sharp rise in the markets. Indicators are still not too stretched, but it has gone up for a long time. We are due a pullback, and let's face it, a pullback of 2.5% doesn't take us anywhere near year-end starts. So I think what we're seeing is entirely consistent with finally the market saying we have to pull back. It's looking for some excuses. Interest rate rising is an excuse. The growth perhaps leading into interest rate rises is another excuse. So I really see it as just a normal movement in the market that you'd see at this stage.
Okay, normal movement in the markets. Richard, good morning. So what do you expect as far as the rate hiking cycle is concerned? Are we looking at a March rate hike from the Fed and the new chairperson? And if yes, do you expect to see any further jitters in the market?
Well, I do see that. We'd like to see a rise from the Fed. We're looking at 3 this year. I think that's reasonable. Of course, we have a new Fed chairman in, and in fact, 3 new senior members of the Fed board have come in. So there's every likelihood we are going to see these rises continue. We might even see more rises happening, although it does look as if Governor Powell, who has taken over from Janet Yellen, is likely very much to follow her view or her move, which was rather stable. But it so often happens that you have a new person come in that they're faced with a new series of challenges and issues. So who knows where it may go.
Okay. Richard, good morning. We may not be in bubble territory, but we had a huge rally, especially in the last quarter of last year. So you think this market needs to give up some more gains before buying resumes?
Yes, I do. I think that, we saw something like 6.5% on the Dow in the last quarter. We saw nearly double digits in Europe in the last quarter. So, losing, what have we lost, maybe 3% or so off those highs, is that not that high? It's quite reasonable. We might even see a double-digit pullback if the market feels that the news is a bit worrying, if we have some troubling stories about the long bond moving up and some troubling stories about companies moving into debt. All of these things can happen. But I do think we probably are in a dip scenario where you could buy. I suspect it's a little bit too early to trade it just yet.
All right. Albert Lung is also with us, the Asia ex-Japan rate strategist at Nomura. Albert, the entire EM basket, tell us, which of the bond markets are worth buying? And what about India in particular, where the yield surge began much before the US yield?
Yes, good morning. So yeah, obviously, I guess the U.S. rate sell-off has, taken the market by a little bit of surprise, right? Especially as typically, if you have a big fall decline in the equity markets, you will have expected some safe haven flow into U.S. bonds, but it didn't happen. So in fact, the U.S. curve actually bears steepened. So I think that it is partly, of course, because of the very strong and non-farm payroll, in particular the wage growth. So basically what the market is pricing right now is about 3 hikes this year. But beyond this year, the amount of rate hike price is still quite shallow. So the market seems to be increasing the risk premium on that front. And also from the second quarter onwards, the U.S. Treasury will be increasing the bond supply. So it comes at a time when we talk about tax cuts, increasing the burden on the U.S. budget, and also maybe some foreign central banks starting to buy a little bit less Treasury. So I think all this is added up. So overall, right? So you asked about the implication on
India.
Asia bond market. And also India. So for first of all, the Asia bond market. So Asia bond market, we actually expect the curve to steepen in Asia because we think that the long end bonds will be more sensitive to the U.S. bond yields, whereas the front end is still more a function of regional monetary policy.
Yeah.
And we don't expect Asia central banks to hike very aggressively in this year yet. So that's for Asia. But as for India, we are currently have a neutral stance on bonds. So as you say, that it has sold off a lot already. But so it may actually, from a pure level perspective, there may be some value. But what we think is that we want to see through the RBI policy meeting this week first, because the bond market has reacted quite negatively to the budget.
Yeah.
Okay.
And so we want to see if the RBI would interpret the budget as inflationary first.
Okay.
So at the moment we are fairly neutral on the bond market at the moment.
Okay, fairly neutral on the bond market in India. Thanks, Albert, for joining us. Richard, just leave us with your view specifically on the Indian market, because we've seen a huge sell-off. Of course, not as bad as what we've seen in developed markets, but do you get a sense that emerging markets like India could continue to underperform some of the developed markets going into the rest of the year?
I don't. I think that where we are in the cycle is the time of the cycle when the emerging markets tend to do quite well. You know, we've got Europe, and Europe's recovery doing reasonably well. I think it'll be positive for equity markets there. And it's also the time of the market when you often get some rotation of assets from developed market investors through into emerging markets. So I think that there's still likely to be some element of fund flow pressure throughout the year and throughout the part of this cycle. And that's the kind of model that you hold to if you have the kind of roadmap that I have, which is, so yes, this is a dip. It might be quite a sharp dip, but we're not yet at the end of the cycle. We're not yet in bubble territory where we're going to have a big crash. So I think this particular bull market is likely to continue, and that would favor emerging markets, commodities, commoditized markets, and also one or two lagging markets that haven't quite followed through.
Okay. Good to hear that, Richard. When the Asian markets are a sea of red, good to hear a voice of some optimism. Thank you very much for joining us.